So if you build kind of a financial statement for yourself, what you're doing is you're going to work to generate an income. Out of this income, you're going to have to pay taxes. That's going to be automatic if you're getting a W-2 salary. So now you pay your taxes, and then you have some money that hits your bank account, and then you pay for your expenses. You got to pay for your house, your car, your groceries, and everything in between. And then if you have any money left over, this is now the money you want to convert into this equity. Now, when most people think of equity, what do they think of? They think of, oh, I want to build equity in the home that I live in. But unfortunately, that's one of the worst kinds of equity that you can have when it comes to actually building wealth, because this home that you live in is not making you any money. Now, sure, maybe it goes up in value, but you don't actually realize that money until it comes time for you to sell, and then you don't have a home. And you have to pay every single month to live there as well. You got to pay for the property taxes, the insurance, the maintenance, and everything in between. Other types of equity that actually build wealth, what wealthy people are working towards. Because if we talk about any wealthy person, like even the wealthy people that I talked about in this video, none of them got wealthy because they paid off of their home. The way they build wealth was an equity in something else. So this can be equity in stocks. It can be equity in real estate rental properties. It can be equity in your own business. That's the equity that is building the wealth. And now the nice thing about this equity is you're working for the profits. You're not working for the salary, right? You're working here for the salary. You're going to work every single day to generate this income. You got to pay taxes on the income. But guess what? When you go and work to generate money for your investments, now you qualify for the first thing, which is the tax benefits. As an attorney who's not your attorney, what I can tell you is if you invest in a stock and you own the stock for more than a year and you sell it for profit, this is called long-term capital gains. And this is taxed at a lower tax rate than the money you make from your job. So if you made $1 million from your stock market portfolio and you made $1 million from your job as a surgeon, as a celebrity, you're going to spend half of this money in taxes. When you earn this money from your job, half of it's going in taxes. But when you made this money from your stock market investments, 20% is going in taxes. You get to keep more money for yourself. And then the second thing is you can also qualify for more tax breaks as well. When you go and invest your money in real estate, guess what? Now you also get to qualify for more tax deductions to lower your tax liability. When you go and get a dividend from the stock market, if you go out and invest in the Meta stock, for example, I'm not telling you what to invest in, I'm just giving you an example. When you get a dividend from Meta, when this profit distribution hits your bank account, because that's what a dividend is. A dividend, which not all companies pay, but some companies pay this dividend, which is a quarterly check. It's a payment that automatically gets deposited into your bank account where the company that you invest in, the stock, has a lot of cash left over. And what do they do with that cash? Well, instead of reinvesting this cash, they just give it away to their shareholders. They give it away to their investors. Now, not all companies pay a dividend. You got to figure out what the dividend is, but this is money that gets deposited into your bank account. Now, the nice thing about these dividends is the tax rate on these dividends are also lower than the tax rate you pay when you make your money from your job. The money you make from your job, your ordinary income, your W-2 income is taxed at the highest tax rate that a tax code has to offer. When you make money from investments, whether it's stocks or real estate, you get to qualify for lower tax rates and higher potential deductions. But now you also are not just relying on your income to get paid, because now when you go out and invest in another company, guess what? Now the company has employees that are working to grow the profits, to grow the value of the company. Now, are you guaranteed to make money when you invest? You got to understand this. You got to understand this. You got to understand this. You're never guaranteed to make money when you invest. In fact, you will probably lose money at some point. Every investor does. So make sure you do your own due diligence and never blindly trust a random guy on YouTube. But this is where you got to understand that wealth is built through owning equity. Wealth is built through investing your money. Wealth is not built through your income. Look at what wealthy people are doing. The reason why wealthy people don't want a big salary is because they know it's going to cost them the most money in taxes. It's going to cost them the most money in the valuation of their investments. It's going to cost them the most money long term. They want to see the value of their investments rise, not the value of their salary rise. Now, of course, you got to pay for your groceries, you got to pay for your house, so maybe you can't do that yet, which is fine. But what you can start thinking about is how can you start improving the value of your equity, because that is what has built the wealth for every single wealthy person in this country. So now you got to start putting on your investor mindset, you got to start putting on your wealthy mindset and understand how you can do this for yourself. And that means now you don't spend all of your money, so you have money left over, so you can go out and invest in things like stocks and real estate and maybe your own business. Now, I do want to kind of give you a little piece of caution here, because it's very easy to get caught in the trap of, oh, this is the next hot stock, or markets are crashing, or these emotional investing decisions. And this is where I want you to take a step back and understand, number one, market crashes happen. They're a part of our economic system. Use them as an opportunity to buy more, not as an opportunity to sell out of fear. Number two, I want you to understand the trends. I want you to understand what's going on, and I want you to not let the emotions get to you. An easy way to understand this, Market Briefs is a free newsletter that my team created at Briefs Media to break down what's happening in the financial news in 5 minutes or less, and it's completely free. If you have not joined Market Briefs yet, I got the link down in the description below. And number 3 is understand that investing is a long-term game. This is not something that happens overnight, over 6 months, or really even just 6 years. I mean, if you got to give it time for your money to grow, that means years and decades to really see the long-term growth of your investments. But that requires the discipline to keep investing your money, because that means markets go up and down, and you just got to keep investing your money, working to build that equity. That way you can have more investments that are working to make you even wealthier. That way you can win in this economic system. If you got a lot of value out of this video, I would love it if you could give me a thumbs up and subscribe to this channel. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.